Hey, my friends, we are back on another episode or rendition of the San Diego Market Update. This is the March edition. So, welcome. I'm excited to be able to do this here with you live. And just to verify before we get started, I want to make sure that you can see me and you can hear me as I always do. Just make sure the audio, the video is all coming through clearly. So, if you could please just go to the chat and just let me know. Just respond with yes, or if you can see me, if you can hear me, just type yes, or I can hear you, whatever you want to type in there, or you could even just send me any message you want. All right, good. So that's starting to come through, and I love that. All right, appreciate it. Looks like everything's working correctly. Let me pull the slides up. My commitment to you here over the next 30 or so minutes is going to be that I just provide you with information that is absolutely different from what you're typically going to hear in the news, because the news's job is, of course, to scare us, to give us nasty headlines, clickbait, all of that. And they're not really incentivized to interpret information in a way in which you can take action with it. And today I'm going to bring you a perspective and some data that's very, very different from what I've brought to you in the past. And so I think this is going to be highly educational, and let me know what you think about it along the way. I also answer 100% of every question myself. I answer them directly. So you can throw them in the chat. And of course, you can reach out later, email, what have you. But I do go through the chat when I'm done with this, and I make sure that I answer all questions. So with that, I'll pull up the slides. Let's go ahead and get started. So this is the San Diego County state of the market. And here, in fact, I'm going to just change this little setting because I want you to really be able to see the charts that I'm sharing with you. So let's let me come back here to the default setting. All right, one quick moment. There we go. I like that. All right, I'll just make my camera a tiny bit bigger and we'll take off. All right, guys. So San Diego County, state of the market. Here we go. Just as a quick introduction, if this is the first time you spend time with me, I'm Dan Beer. I run the Beer Home Team Media XP Realties. I've sold over $2.5 billion worth of real estate here locally in San Diego. And that's been over the last 17 years, which has landed us on the Wall Street Journal list of the top 50 teams in the entire country across all brokerages. Inc. 5000 recipient 4 times. San Diego Business Journal named us among the best places to work. And it actually named us the top team in the county. And I've been an expert guest on NBC, ABC, Fox Local News, all just to say that I've been through a lot of markets. I have seen a lot of things. I've been through several thousand transactions, up, down markets, etc. And so more importantly, a lot of you know me as that guy on the billboards, but this is really who I am right here. So this is, there was just about 700 agents that flew in from different parts of the country to learn how they can improve their real estate practice. And so that's the room you see there. That's at the Hard Rock Hotel. You see my daughter there, who it was just her 6th birthday along with her twin brother. And there's my 2 boys. I took them on a little ski trip just now. So there you are skiing. There they are in the car falling asleep on the way back. And it's just a lot of fun. My little guy in the cockpit there on the airplane. So just a little quick insight on who I am. Let's jump in. You've seen me share these statistics with you every month. I share them. I'm going to just give you the ones that really jump out at me, because I want to get to other data that's quite different from what I'm normally sharing with you. But worth mentioning going through this, that look, there's not a lot that's changed. New listings are still down. Inventory is still down. Pending and closed sales are down. But like I said, the news will give you those headlines. Take a closer look. The news is going to report, hey, in pending sales, for example, down severely from a year ago. Well, that's true. They're down 29.7%. But look at that little graph, that bar chart. We have had 2 consecutive months of rising pending sales, which is awesome. That hasn't happened in quite a long time. Okay, there was a little blip there, as you could see, where it went up very shortly about 5 months ago. And then before that, it hadn't happened in well over a year from now. So that's nice to see. I do want to just point your attention to the days on market. Okay, they're far higher than they've been in really a long time. 41 days as opposed to what it was this month a year ago, 22 days. So in market times are up 86.4%. And I would also just point you over toward month supply. Month supply, here's an interesting one, right? Again, kind of counter to what you're going to see on the news. They're going to say, hey, month supply, we're 42% higher than a year ago. True. Having said that, look at that trend line on the bar graph. It's actually, supply is actually starting to decrease again because we're starting to see some more market activity. So kind of just something to keep watching there, but the general trends are largely the same. Quick to just cover mortgage rates, inflation. So 30-year mortgage on a $900,000 home, 20% down payment, which would be a $720,000 loan. Today we're at 6.62%. That'd be a $4,600 payment. Same payment when rates were at 3% was $2,951. So that difference between today and the lowest rate back then, $1,659 higher, but that does not account for wage increases. And so when you account for wage increases, that affordability gap gets far, far, far tighter. It's about half as much as what you see there. And it's just something important to keep in mind. Take you really quickly through what we are predicting that the Fed will do next. So this is really interesting. Right now, the federal funds rate, which is that rate that banks borrow at, okay, that's not a mortgage rate, but it's that banks will borrow, or rate banks will borrow at. It's 475 to 500 basis points. Okay, so basis points could just be read as 4.75% or 5%. So there's 100 basis points in every 1%. Well, if you look, the next time the Fed meets, which will be on May 3rd, this is Wall Street. The way Wall Street is betting here, the probability, the money is betting on the fact that rates will not increase at all. The market is, for the first time since this entire, all these, rate shenanigans began, it's the first time that they are predicting that rates will stay steady and the Fed will not raise them. So that's the bet. But you'll see there's a pretty reasonable chance also that there's a quarter point hike, right? You see that to 500 to 525, 40.6%. So that's a pretty, it's kind of in that 50-50 range. When we've looked at these charts in the past, there was like 90% probability of something happening. The whole market agreed. Well, that's not the case anymore. So it's pretty split between a quarter point or just sitting still. Then you'll see the market is betting that on the June 14th meeting, it'll stay there again at the 475 range, and that on the July 26th meeting, it'll stay on the 475. So in other words, high probability that we're done, that the Fed is, at least for now, done raising rates. And that could be tied to all the bank issues and everything that's been going on. The reality is we're not going to get deep into those bank issues here. Those bank issues have a lot to do with nothing to do with what we care about here in San Diego locally. So because those are very specific issues with very specific banks with very, very, very high net worth technology clients and venture capitalists, just unrelated. So that's kind of interesting that essentially we either have maybe another quarter point hike or we're done, which is kind of nice to see. So why would that be? It's because inflation is on the way down, and inflation is the number one determining factor when it comes to interest rates. Okay, inflation is starting to come down, and it's really that main driver of rates. And so we believe it will continue to drive down, by the way, based on a recession that could very easily be announced. Okay, anytime a recession is announced, if you look at the history, rates will drop. Rates will drop, and then money will come out of the financial markets and into hard assets, real estate being one of them. So historically, real estate's actually performed really well in a recession. One of the reasons why is it will also create downward pressure on rates. And we're also knocking off really high CPI readings from 10 months ago, from 11 months ago, 12 months ago that are starting to come off inflation readings. And again, inflation's a measure of a look at 12 months and how they, they're cumulative, or how they add up cumulatively. And as we drop off those old high months, we're replacing with lower months. So of course that creates a lag effect. And that's just something that you'll see more of here in a minute in an illustration that I'll show you. Now, shelter costs. Let's talk about this. I don't think we've ever really gotten deep into this, but shelter costs make up 43% of CPI, of core CPI. Okay. Now, the issue with that is that, again, they take a 12-month reading. And so when you look, this is really looking at rents, okay, and that year-over-year rate at which either rents are increasing or decreasing. So rents are still increasing at a rate of about 3% year over year, but at one point they'd reached over 18%. Okay, that's this high mark that you see on the screen. So when rates were increasing at that high mark of about 18%, all of that is still baked into the core CPI reading, 43% of which is made up of shelter costs. So all that's going to carry with us. And so what that creates is this huge lag effect where if they were taking a snapshot in time, you'd see 3%, which would have a very different effect on the inflation numbers. But instead, they're carrying these old numbers with us. And so it's just kind of like a roller coaster, as you could see here, right? Like the front end of that is already on that lower end, right? Only 3% increases in rents. But the tail of the roller coaster still includes all of those higher readings. And so it's that lag effect. And that's really what we're experiencing on that reading. You can see right here in this chart that if you really kind of do a calculation, okay, because this blue line that you see, that's CPI shelter change year over year. And you'll see that it hasn't quite come, it's still sort of on the way up while the shelter costs are on their way down. And as we get further out, many months from now, that blue line will start to curve down. That's that lag effect we just looked at. So in essence, if you do run a calculation on that, you see when we're at 4.9, okay, which is the difference, the delta between 7.9 and 3%, okay? So the gap between those two numbers is 4.9. And then you multiply, you take 43% of 4.9, 43%, because that's the amount that shelter costs factors into inflation reading on the core CPI, you get 2%. So in essence, that's creating a 2% increase, artificial increase, if you're taking a snapshot in time, on what should be the CPI reading. So that tells us inflation should be coming down. Why do we care about this? I mean, why am I giving you an inflation update, right? It's not because I'm trying to give you an economic update. It's because this is what drives interest rates, mortgage rates. Mortgages are very much driven primarily and beyond anything else, they're driven on inflation. Now let's take a quick look at this, and I'm going to bump myself out of the way here. Let's go to the left side of the screen. All right, that worked well. So just a quick little history on inventory. And by the way, again, feel free to jump into the chat, ask any questions. I will answer every single question myself. I always do. And taking a quick look at inventory. So the market, when it topped out prior to the Great Recession, 4 million units on the market, 4 million. Today, 980,000. So I'm just sharing that because there's a huge disparity, 4 times less inventory than what was, or there was 4 times more inventory then than what there is now. And so it's this low inventory environment, which creates a very unique buying situation, which I'm going to share with you right now. If you're wondering, well, should I buy into a recession? Should I buy before a bottom's been declared? I'm going to I'll take you through the math so you could just make your own decision. But this is a core driver of what's going on. 4 million units then, 980,000 units now. So, and of those 980,000, 402,000 of those units, by the way, I'm giving you national numbers because I want you to understand nationally what is happening, because San Diego is echoing very much. It's leading the way in terms of what's happening in the nation. And it's just important because you start to read the headlines on all the big newspapers, the CNNs and the Foxes and all these, all these big news channels, whether print, paper, internet, whatever it might be. And it starts to shape your mind. And that's what they're looking to do, right? They're paid to shape the way we think, but we need to be able to interpret the information for ourselves. So 402,000 of those 980,000 units are actually off the market. They're pending. They're in escrow, meaning that there's really only 578,000 units to choose from. So this just gives you I'll go through this one super quick because this is just an illustration so you get a real grasp on how low inventory levels really are. You'll see where they were in 2017, 2018, 2019. They were way up there in that 1.2 million range. And then they dropped with the Great Recession, or not with the Great Recession, but with COVID. So that's the COVID recession right there, 2020. and they drop. Now, while we're not at the absolute lows that we saw in January of 22, we are still very, very low, about half of that historical low, or of that historical trend line. So it's just something to be really, really well aware of. And so you start asking yourself, should I buy now? Should I buy then? Where should I be? Let me be the first to declare, by the way, that you should maybe just do nothing. And I really mean that. If you're in the property, I say this constantly, if you're in the property that suits your lifestyle, you're happy, and it's going to suit your lifestyle over the course of the next 7, 8, 9, 10 years, there's no real reason to care about any of this. You should actually tune out, go enjoy your life. Like, it's fine. There's no need to be caught up in if the market's high or low or this or that. You're probably locked into your interest rate. You're good. So I'm not an advocate or proponent that everybody needs to go do something. I don't think that's the case at all. But if you're considering, hey, is this the right time? Is next month the right time? Should I wait 5 months? Should I time it? Well, it's important that we just, face reality, right? That we just face reality that if rates ever were to change, which they will, values will be going up. Okay. Values will be going up. And so the real issue is you have to look at this chart and this kind of U-shaped thing. It's just a representation that says, hey, well, if I want to time the exact bottom, how will I be able to do it? In San Diego County, there's going to be about 30 or so thousand homes that'll sell this year. 30,000 homes and condos that'll sell this year. So there's only, whatever it is, 600-700 properties that are going to sell like the week that we hit the bottom. Everyone else is going to miss it. Okay. Everyone else is going to miss it. And I'm not sure that any of us are good enough to time that. I'm certainly not. And so the very highest likelihood is not to be one of those 600 or 700 that happened on that exact bottom, but that you're going to either miss it on the way down or you're going to miss it on the way up. And there is a huge case to be made for missing it on the way down. Okay. Because on the way down, okay, before the bottom, there's a lot less competition from other buyers. Okay, interest rates are still kind of a little bit higher. They're propped up right now in that 6.6 range, 6.7, 6.5. So rates are considered to be on a little bit of the higher side. There's less buyers. More importantly, sellers are more fearful. Because it's interesting, everyone's waiting and watching for the news to declare that we hit the bottom. But can the news declare that before it's already happened? They can only declare it when it's history. So when it's declared, we're actually on the way up. And what happens on the way up is that sellers are feeling more confident. There's more competition. One of the things that'll probably be driving us there on the way up is that interest rates have dropped. For every 1% in interest rate drop, 5 million buyers are created. So there's now there's just a much higher likelihood of a multiple offer environment, which will create upward pricing pressure. Okay. And so we want to miss the bottom, which we're just going to assume we're all going to miss the bottom, but we want to miss the bottom on the way down, not on the way up, because we have more negotiating power. Sellers are more fearful. We can get more credits. There's more we can negotiate during the repair process. We have more control. And the miss also gets us closer to the bottom, which is kind of interesting, right? But if we go over here and take a look at, so this is an actual illustration. Okay, this is just for illustrative purposes, but this is an actual look. I shouldn't have called this one an illustration. This is a real look of how it works, so that U is not symmetrical. You see on the way down to 2012, how it was sort of flat. So missing the bottom, you're kind of not that far from it anyway. But look at how it spikes up much more sharply. The angle becomes more aggressive on the way up. So missing on the other side of the bottom every day costs you more and more and more. And what's interesting is we've just lived through this market. If you look at the 2021 market, for example, you'll remember it. I mean, it's recent past. Either you were in the market at that time or you know someone who was making offer after offer after offer, who couldn't get in, who thought they might buy in April, didn't end up buying until October for a wildly different price. And so on the way up, there's much more acceleration than on the way down. Think of yourself as when you like drop a tennis ball, for example. On the bottom, there's actually a pause, and then it springs up. And so that's what you're seeing right in front of you. In fact, from 2012 through the next year, there was 8% appreciation. 8%. But here's the kicker. In 2012, there was 2.4 million units of inventory on the market nationally. Okay. There were 2.4 million properties on the market. Today, 980,000. So if in that environment, appreciation from that market bottom sprung 8% that year, which is a big number, then what's it going to be this year? Is it going to be more? Is it going to be less? I mean, time is going to tell us, but it's fair to say, if we just take a really conservative look at it, it's fair to say that it's going to be at least a couple of percentage points, right? At least 3%. So let's do a little quick math calculation, and you tell us, or so you can see how you can use this environment to as a market opportunity. How you use this as a market opportunity. So I'm going to take you through the math here, and let me bump myself over to the other side. There you go. It's musical chairs here, trying to stay out of the way. Nope, I'm going to keep it big. Well, there you go. All right. So let's take a $1 million house. Just makes the math easy. $1 million house, mortgage amount's $800,000. Rates have risen about 1%. Okay. Rates have risen about 1%. Monthly payment increased 30. If that happens and you get the rate 1% higher than where it might be sometime from now, then you have about a $384 higher payment, which over the course of a year is $4,608. Opportunity. Okay. The opportunity for you to, in this environment, prior to that bottoming out in this environment, you have an opportunity of maybe negotiating the price by 2%. Is that fair? Okay. I mean, that's what we see in the field very conservatively. So you could probably negotiate that $1 million house for just right. Total hypotheticals, $20,000 less, 2% less. So you're buying it for $980. And the prices, once that bottom comes and bounces, instead of getting the 8% that we saw back here, instead of this 8%, if we calculate it at a measly 3%, and keep in mind, by the way, guys, these were national numbers. San Diego actually saw a larger jump. So if we get this, if we just take that down to 3%, then that's $30,000 of appreciation that will come. So in other words, you were able to negotiate that $1 million property down $20,000, and then you get $30,000 of appreciation. That's a total benefit of $50,000. But the cost of that higher rate that you locked in prior to that market bottom, so you ended up with a higher interest rate, which of course you can refinance later, but because there's going to be a fee to that refinance, right? So there was a $4,600 cost to that higher interest rate. You'll see, remember right up here, the $384 a month, which turns into $4,608. But you're going to have some refinance costs and so on, because you'll want to refinance it later and get a lower cost and get a lower rate. And so let's just round that thing up to $5,000. Okay. So that's the cost of having gotten that higher rate, which means you have a total benefit of $45,000 by negotiating right here in this area versus over on the other side. Again, after that bottom, the sellers are going to be more confident, more competition, less credits, less repair work, less everything. So that's the big takeaway, is how do you use this? Because the reality, if you really look at it and think about it, is it always, it seems like a good opportunity in housing right now, right? It seems like a good opportunity, but the trick is to see how that opportunity shows up, to notice the opportunity, to recognize it before everybody else sees it too. And very few are spending their time on webinars like this one. Very few are doing the math. Very few are really looking and thinking through how all of this math works in their favor when they're negotiating against less competition versus when rates drop. Can you imagine with this low inventory environment that we have, when rates drop, yes, it'll release some inventory, but it's going to be, or some new listings, but they won't be inventory, because inventory is a measure of what comes on the market and stays on the market. So yes, some more will come on, but we witnessed it already. This isn't theory. 2021, low rates, boom, multiple offers galore, upward pricing pressure. Right now, you can negotiate the price down. You could get all the appreciation that's coming, and there's a very low cost to doing so. In the illustration in front of you, a $45,000 benefit. That's what I have for you guys today. I wanted to kind of take you through that because we're getting to that point in the marketplace where people are asking themselves, where are we? What should I do? How do I hit the bottom? The answer is you don't, okay? Or you get lucky. That's the only people that hit the bottom. But people that understand how to play the game and get into the property they want, use all the negotiating points in their favor, knowing they can refinance the property later, we're in the final window. We're genuinely in the final window. I could report to you from the trend, from the streets this past weekend, 7 in the 92127 zip codes, 70 visitors to an open house. We had open houses in different zip codes around the county where we had anywhere from 30 to 40, 50 visitors we had one with 20 visitors at the open house, but it was in Anza Borrego. Okay, all the way out in Anza Borrego. So there's a changing market condition already, and this interesting little window before sellers start to get more confidence, more courage, and start to hold the line a lot more. And then just let alone if rates were to come down, there will be competition that's just going to echo what we saw in 2021. And that's just what the data and the evidence tells me. So I hope you find it helpful. Please drop your questions, and I will be sure to answer every single one of them. You can email me directly into my inbox that I monitor. It's dan@beerhometeam.com. And again, whether you're buying a home, selling a home, whatever you're doing, in 9 days, in 9 months, in 9 years, we don't care. We're here to make this entire thing easy for you. We're here for the absolute long term. We don't actually care if you're doing anything at all. If you have a question on a bathroom remodel, reach out. We'll help you out. And if you're watching this on YouTube, make sure you hit that subscribe button and tap that bell for notifications so you're the first to know of any changing market conditions in San Diego. Thanks, guys. We'll see you on the next one.